When I get the financials from a company, I break it down with these models. I'm going to share one with you. I call it the REAL framework. REAL, the REAL framework. And what that helps me do is break down the accounting that I see into one single slide. I break down accounting into 4 boxes: revenue, expense, assets, and liabilities. That's how I break down accounting. Now, revenue, expense, assets, and liabilities. Your revenue and expense obviously is your P&L, your profit and loss. Your assets and liabilities is your balance sheet. And really, this is the entire financials of a business. That's it. That's what it is. Why it's so nice to use this simple back of the envelope way of analyzing accounting is that the top side, the revenue and the asset side, is internal to the business. You say the top side is internal to the business because the business takes assets and converts them to revenue, and hopefully after the expenses, which is on the bottom side, which get paid out. Yeah, the company pays that out. So the expenses are external to the business. Your liabilities are also external. Your liabilities and shareholders, they are external. The business is a separate entity, right? So your liabilities are what is used, I think I prefer to call it funding. Your liabilities of funding fund the assets. So if you look at the business in this way, you can explain certain things in the accounts. So let me attempt to do that. The accountants in the house will love debits and credits. So here are your debits and credits. You have your debits and credits. Your expense and assets is debit. Your revenue and liability is credit. So as a modeler, when you're analyzing the historical financials, for example, and you do a simple analysis, you think, okay, why is revenue, what's wrong with revenue? Revenue seemed to have spiked in this year. What happened? Was there more revenue? Was there something great that happened that the business started growing? You need to know, as thinking like a modeler, okay, what are the things that could happen to revenue that don't necessarily mean the business is growing? So if you see the credit side, you know that probably there's a liability that got shifted to revenue, because you see the X. I would like you to draw an X, right? An X in the middle. And this is where some shenanigans happens in accounting. So if you have something called unearned revenue and you decide to do revenue recognition early, it will move from liability to the bottom right to a revenue at the top left. So you thinking about that and looking at this model is what we mean by thinking like a financial modeler. Without any numbers, you could say, okay, these are possibilities that could happen in this industry. So you will build models like this. You would have tools like this to help you think like a financial modeler. So that is principle 2 of thinking like a financial modeler. Keep it simple.